Okay, good morning, everybody, and welcome. Thank you for joining us for the first private client webinar by DMH Dallard. I'm pleased to be joined today by my colleague, Stuart Price. Stuart came to the firm earlier this year. He's joined us from a respectable firm in Tunbridge Wells, where he has over 5 years experience in their tax team. Most of you know me, Camilla Bishop, partner at DMH Dallard. I've been specialising in inheritance tax for some time now. So what are we covering today? Whereas the title to the seminar suggests, I think that time may be running out for inheritance tax planning as we know it. Try and imagine a regime where you can't make a potentially exempt transfer, or where you can't make a gift without being taxed, or capital gains will be taxed at some point, so there's no uplift on death. Hard to imagine, but that could be what we're faced with in the future. So in terms of what we're covering today, we will be looking at traditional ways of planning, so using wills and nil rate band trusts, capturing business relief and agricultural relief, the setup of family trusts, and then planning around the main residence, the high value asset, perfect for planning with because there's no capital gains tax and it's not income generating. We'll also be looking at property portfolios, problematic assets to plan with, so what you can do there in some circumstances. And then lastly, looking at when a family investment company might be appropriate. So we'll be taking questions at the end, time allowing, which we hope there will be. The seminar should run for about 15 minutes with time for questions. So please do type in your questions in the question and answer button at the bottom of your screen. So without any further ado, let's get going. So just a review of what we're covering on the contents page. Stuart is going to cover the traditional planning, and I will be looking at planning with the main residence and the company portfolios and family investment companies. So handing over to Stuart shortly, but before doing that, I just wanted to recap on the all parties parliamentary report, which recommended some really radical changes to the IHT regime back in January this year. So they were suggesting doing away with potentially exempt transfers as we know them and replacing it with a flat rate of inheritance tax, whether that's 10% or 20%. It would be a tax on lifetime gifts or gifts on death. So regardless of when they're made, if you make a gift, it's taxed. They were also suggesting that business relief, agricultural relief go, that the residence nil rate band is scrapped. I'm not too unhappy about that. That's a terrible piece of legislation. The sooner that goes, the better, although it would bring many families back into the IHT regime. So notably, the other suggestion that the all-party report made was the removal of the CGT uplift on death. So effectively creating a kind of holdover relief on death so that the beneficiaries take the asset at the same base value that the deceased held the asset. So this means that if you make a gain on an asset during your lifetime, you would be taxed at some point when that gift is finally sold, when the asset is finally sold. Now, due to the pandemic, these recommendations haven't had government attention yet, but I think that they will as part of the much larger tax clawback that inevitably we are going to see in the coming months or years. It may be next year, it may be in 2 years' time, it may be 5 years' time, we just don't know. But probably some of these recommendations will become a reality, and we need to think about what we can do now that we won't be able to do in the future. So handing over to Stuart, who's going to start with tax planning wills. Over to you, Stuart.
Thanks, Camilla. Yeah, so what I want to talk about today is some really simple ways we can use trusts in wills to secure quite valuable reliefs. I think a lot of you will have a bit of awareness about a lot of things I'm going to talk about, but there'll be definitely a few bits of information in there which will surprise you in the amount of inheritance tax a simple bit of planning in the will can save. So really briefly, who needs one of these tax planning wills, or who needs to think about one? It's couples with assets over 1 million or close to, couples with jointly owned property, and of course couples with business property or agricultural property. And I will just say, before moving on to the next slide, a lot of the trusts and a lot of the tax planning trusts that I talk about during my slides, they do have other advantages such as asset protection, but I'm not going to cover those in much detail today. It's a bit outside the scope. So the first thing to talk about, really simple, is nil rate band trusts in wills. We're all familiar with these. So these are trusts that we used to put in wills where we give the nil rate band on the first death of a husband and wife. We've been seeing those less and less frequently since the change in the law after 2008. But when we have clients who come in and talk about these nil rate band trusts, perhaps they've read that there's no longer a need for them, or perhaps they don't understand them, we're saying to them, hang on, slow down. Let's just think about what the advantages of these nil rate band trusts still are. And the slide there just outlines, well, 5 of the advantages of having these trusts in wills, and we'll talk through those very briefly. So firstly, assets in the will trust will increase in value. So if we get £325,000 worth of property outside of the estate on the first death, if those assets that fund the nil rate band trust increase in value between the first and the second death, then that increase in value is outside of the estate of the survivor. So there's an inheritance tax saving there. Second box, it reduces the value of the survivor's estate. Why would we want to do that? Well, Camilla's going to talk a little bit later on about the residence nil rate band, which you'll all be familiar with. Well, that suffers tapering relief as the combined estate exceeds 2 million. So what we're advising people to think about doing, especially those in the sort of £2 to £3 million worth of assets bracket, we're saying on the first death, let's fund a nil rate band trust with £325,000, and then that reduces the value of the survivor's estate for the purposes of the residence nil rate band. I got up there in the third box, asset protection. I said I wasn't going to talk about that much today, and I'm not, but suffice to say that assets which fund the nil rate band trust are outside of the survivor's estate, so they're not as vulnerable to decisions made by the survivor, or indeed the influence of third parties on the survivor. Fourth box down at the bottom left there, we've got that it allows 3 or more nil rate bands to be claimed. And some people will be familiar with this, but some people won't be. But it's important to know that on death, at any one time, a maximum of 2 nil rate bands can be claimed. So where that can present a problem is if we see a husband and wife, perhaps one of them has been widowed before and that previous spouse left everything to them. Well, what we have there is we have 3 nil rate bands available to those 2 people in front of us. So if we left the will standard and didn't think about a nil rate band trust, well, everything would be left to the survivor on the first death. And then on the second death, we look at the estate, we see that we've got 3 nil rate bands available. We can only use 2, so we've lost 1. And that's a huge nil rate band, huge value to lose. So what we do is we simply say nil rate band trust on the first death, so we can use at least one of those nil rate bands. So when it comes to the survivor's death, we're not wasting any nil rate bands. And finally, the fifth box, which I want to talk in a little bit more detail about, because it's, I think, one of the least known, is the nil rate band trust allows us to take advantage of the joint property discount. And that's what I'm going to talk you through in a bit more detail on the next slide. So, thank you, Camilla. So, joint property discount, we're talking to all of our clients about these really simple bit of planning that can save really significant sums. The joint property discount, how does it work? So on death, you'll all know that the assets of the deceased are valued, and HMRC looks at these values. HMRC accepts that a share of jointly owned property is not worth the respective percent of the whole. So this really works well for jointly owned property owned by a couple. So I'm going to give an example of how this will work in practice with a little example on screen there. Firstly, I'll show you what happens if we don't look to take advantage of the joint property discount. We've got a husband and wife, no children, they've only got no children, so we're not bringing the residence nil rate band into the calculation and complicating it a little bit. It doesn't mean, sorry, I should be clear. So joint property discount does work for people with children. I've just given them no children in this example to simplify things. So only asset, let's say, is the house valued at 1.2 million, and that's due to increase in value between the first and the second death. If we left this couple with simple wills, leaving everything to the survivor, well, everything goes to the survivor on the first death, fully exempt for IHT, and on the second death, the property isn't jointly owned, so we take its full value into account for the purposes of calculating inheritance tax, and we've got the sum there showing the amount of inheritance tax due if we don't do the planning. If we go on to the next slide, we'll see how the joint property discount works. So if they'd come and spoken to us, this couple, we would say, let's talk about putting a nil rate band trust in the will to take advantage of the joint property discount. So how does it work in practice? So husband dies with the nil rate band trust. On his death, we fund that nil rate band trust with a share of his jointly owned property. Now, as he jointly owns it with his wife, we're able to get a discount on the share going into the trust. So the end result is the trust receives a share of the property valued at £382,000, only at the cost of his nil rate band. So we've already got more out of the estate. So we've already achieved an inheritance tax saving. But where we see its real benefit is the rolling up of the benefit on the second death. So later down the line, wife dies, she still owns her share of the property, which has gone up in value. So when we come to value her estate for the purposes of calculating inheritance tax and getting the grant for probate, we look at her share of the property and we see that it's jointly owned. She jointly owns the property, not with her husband anymore, but with a trust. So she achieves a slightly reduced joint property discount of 10% on her share. And the figures are up there. I'm not going to go through those in detail, but the key point to take away is in this example, just having the nil rate band trust on the first death saves £68,000 worth of inheritance tax. And that's not an abnormal amount of saving. I mean, generally we're seeing an average of about £50,000 where we use these. So it's a really good saving, all for the cost of just having one of these old-fashioned nil rate band trusts in the wills. So really simple stuff. And a lot of the criticism levied at these nil rate band trusts are, the clients don't like the administration or complexity. What we'd say in this example is that the nil rate band trust is going to be funded just by a share of the property. So it's a non-income generating asset. It's a really simple administration. Yes, there will be the 10-year inheritance tax charge to think about 10 years down the line. But what we would do is we would diarise to contact the client, if the survivor is still living, to see if there's any planning that can be done with that trust at year 9. And finally, some people think, oh, what is this going to do about the principal private residence relief for capital gains tax? Because, of course, wife only owns half of the property, the other half is owned by the nil rate band trust. Well, it's just to say that we can look at giving the survivor a right to reside to get around those issues and make sure there's no negative from a capital gains tax perspective. So, in summary on the slide, if in doubt, I think include a nil rate band trust for the reasons we've explained. So it saves inheritance tax in its own right, works to protect the resident's nil rate band, and it can provide some level of asset protection. The best part is it's really flexible. If the trustees decide after death that the nil rate band trust doesn't serve a purpose or they don't want it for any reason, then it can be wound up within 2 years and it's as if it never existed. So really useful tool to think about when planning in wills. So if we go on to the next slide, I want to talk a little bit about business and agricultural property. This won't be news to many of you, but just to outline how we use trusts in wills to estate plan with this type of property. As you all know, we advise people with these types of assets which qualify for really valuable release from inheritance tax, which I would add might be under threat from change in the future. What we say to them is, let's make sure we lock in the relief when the first of you dies. Let's get the assets outside of your estate with the benefit of this really valuable inheritance tax relief. So we're locking it in on the first death. that can have advantages later down the line as well, because if after the first death the agricultural or business property is later sold, the cash proceeds then don't form part of the survivor's estate. The cash proceeds will be due to that trust which we created in the will, and thus has passed inheritance tax free to the trust. And if the survivor is concerned about having enough to support themselves or to live on for the rest of their life, then it's important to note that this trust that now has the cash that was formerly business or agricultural property can make distributions to the survivor if necessary, but better to make loans to the interest-free loans, so we're not inflating their estate for inheritance tax. So that's what we can do. Some really simple trusts we can use in wills to secure really valuable reliefs. But in lifetime, I just want to talk about the way in which we can use nil rate band trust in lifetime to estate plan. So at the base level, we can create a nil rate band discretionary trust in lifetime, fund it with cash, and that's limited to £325,000 per person. So a couple could give £650,000 into trust, and if you survive for 7 years, then, as you know, it's outside of the estate for inheritance tax purposes. We don't generally see clients wanting to put more than £650,000 into trust because of the immediate 20% inheritance tax charge, which most clients won't swallow. So why would we want to gift the cash into a trust instead of to children or other beneficiaries outright? Simply that perhaps children aren't mature enough, or perhaps there's something going on in children's life where we wouldn't want to just drop significant sums of cash into their estate. Taking it on a little bit further, we could create a nil rate band trust in lifetime and fund it with assets that are harbouring a gain. A really common asset we see is a couple that have perhaps just one buy-to-let property that they've owned for many years, or perhaps they used to live in it. Well, that's going to have quite a significant capital gain likely if we just give that away to somebody. We're going to crystallise a capital gain. So what we can do instead is gift into a discretionary trust. We can do what's called holdover for capital gains tax, so essentially defer any capital gains tax until the property is later sold, and then the trust will exist for a period of time, and then if we want to wind it up, we can hold over for capital gains tax again when the property is appointed out to beneficiaries, or indeed we might decide not to. If we're pointing out to a number of beneficiaries, there might be enough capital gains tax allowances between those beneficiaries to wipe out or most of or all of the capital gain. So a useful use there. I would just say, if we are still limited to that £650,000, so if there's a lot of properties we're thinking about planning with, we're definitely going to be going into the realms of what Camilla is going to be talking about later. Just a little bit more on lifetime trusts. We've got agricultural or business property. Just as with on death, someone might decide that they want to lock in the relief now, so they might gift their agricultural property into a discretionary trust, and then we've locked in that relief in case the relief is later withdrawn. Finally, we've all got clients who have a little bit of land with hope value. This is value that a client thinks with varying degrees of realism that it's going to go up in value between now and the date of their death. So what we do, we might pop that bit of land into a discretionary trust. If it does hit the jackpot and increase, say, tenfold in value after we put it into trust, then we've got all that increase in value outside of the estate. A couple more points on trusts. Just to note that the nil rate band, the £325,000 per person, refreshes every 7 years. So we would normally diarise to contact the client at sort of year 6 to see if they've got appetite for perhaps creating another lifetime trust. And so on to the next slide. The final thing I'm going to talk about before I hand over to Camilla is deeds of variation. So it's just to say, if clients perhaps don't take advantage of the trusts and the tax planning devices we've talked about today, deeds of variation are a way of correcting missed opportunities. As you'll know, a beneficiary can vary their inheritance or redirect it within 2 years of death. So what we can do is we can correct missed opportunities with this. For example, we could introduce a nil rate band trust. We could manipulate the estate to claim or increase the chances of qualifying for the residence nil rate band. Or indeed, one of the most valuable things we can do is we could redirect into a discretionary trust. So this is where if I've received an inheritance, I can do a really simple variation into a discretionary trust, which I create. I can be a beneficiary of that trust, but the assets within it aren't in my estate for inheritance tax purposes. It really is having your cake and eating it, and it's something we always talk to clients about that have their own inheritance tax questions. Obviously, with deeds of variation, you have to have capacity to sign one. So where we become a bit unstuck sometimes is if one of the beneficiaries is under 18, or perhaps the beneficiary, the surviving spouse, doesn't have the capacity to prepare a deed of variation, we might be blocked there. So always better to do the planning in lifetime, but always think about deeds of variation. So that's all I'm going to talk about today. I want to hand over to Camilla, who's going to take us through the rest of the slides.
Thank you, Stuart. So moving on to planning with the main residence. Now, I really like planning in the main residence because there's no capital gains tax issue because of private residence relief. The asset doesn't generate an income, so your clients aren't losing an income, often a problem. So it's just sitting there, for them to live in. So it's a perfect asset to give away. But obviously the revenue have clamped down on planning with the main residence. We've got reservations of benefit, we've got pre-owned asset tax, general anti-avoidance, and of course DOTAS, disclosure of tax avoidance schemes. So we don't want to fall foul of any of those pieces of legislation. There are, however, vanilla options that are still available to us that we know the revenue accept, are very simple, but they work. Two main options. But before I talk about those options, I have to touch on the residence nil rate band. Not my favourite piece of legislation, as everybody knows. So really, without going over the basics of the residence nil rate band, because I think everybody's got to grips with that, just highlighting for a married couple, there is this really penal marginal rate of tax for estates worth between 2 million and 2.7 million on second death. So the residence nil rate band, 350,000 maximum value, worth 140,000 in inheritance tax, tapers away over 2 million, giving a 60% rate of tax. So what can we do about that? Well, the main residence is perfect because it's worth so much money. So picture an estate, a £3 million estate. Lots of our clients fall into this bracket, 2 to 3 million, with the main residence being around £1 million, and other assets of, around 2 million. If they could get the main residence out of their estate, overnight they save 140,000 in tax on current rules. Huge amount of money, and if they survive 3 years, they get taper relief on that gift, saving tens of thousands. If one of them lives 7 years, you start to save really big numbers. If they both live 7 years, you've saved over $500,000 in tax, 400 in inheritance tax, and 40% on $1 million, plus the residence nil rate band. So very big numbers, which is why it's so attractive. Now, if you make a gift of the main residence, you might be thinking, well, how can you claim the residence nil rate band? Well, the downsizing provisions allow us to do it. So as long as there isn't a gift with reservation of benefit, and as long as the gift is made to direct descendants, so the gift is made to the children, you can still claim the residence nil rate band. Now, you do need other assets in the estate, so equivalent assets do have to pass to the direct descendants, but unless you've got a very strange client who's just got a house in their estate, that shouldn't be a problem. So the last point on this slide, use it or lose it, is really just to highlight that, maybe we should be thinking about using the residence nil rate band on first death. You could introduce a gift in the wills to make sure you claim that residence nil rate band at the earliest opportunity. It might only be worth 70,000, but it's similar sort of numbers to the nil rate band trust and the joint property discount. That's quite a lot of money to most people. So, if we think the residence nil rate band is going to go, really we should be claiming it at the earliest opportunity. Just something to think about. So moving on to the first option with the main residence, if you have a client who has an adult child living with them, then you have an opportunity to make a gift of some of that property to that child. So Section 102 of the 1986 Finance Act gives us an exemption to the gift with reservation of benefit rules. So put simply, where you've got shared occupancy, you can make a gift without paying market rent. You can't gift the whole property, but you can give some of it. So look out for these opportunities. What do we mean by occupancy? Well, there's no statutory definition for occupancy, so it has its normal meaning. So it doesn't have to be the main residence of the child. They can have another property, but they do need to spend some time with their parents in their parents' home to qualify as occupying. The revenue suggests they need to be more than just a guest. They need some element of control. They need their own key. They need to, have possessions there as evidence of occupation and freedom to come and go as they please. So ideally, have their own room, spend, the odd weekend there as a minimum. I mean, usually if it's their main residence, the evidence is overwhelming. But if they do have another property somewhere else, then you might just want to be careful that you are, establishing enough evidence of occupation over the years. The other requirement of the exemption is that the donor, the parents, don't receive a benefit from the gift. So it doesn't work if the children start paying all of the bills and trying to make up for such a generous gift. You're going to cause a problem. There's going to be a reservation of benefit. So it's safest if the parents continue to pay the lion's share of the costs of the property, which, to be honest, is quite normal anyway. So what do we mean by gifting a share? Well, the revenue have made it very clear that if the parents, if the donors keep just a slither of the property, so they keep, say, a 1% beneficial interest in the property, they're going to challenge that. So we don't want to push things to the limit. And the revenue has said per capita, so per head, which means if you've got one child living in the house, you can probably gift up to 50% of the property. So if you treat the parents as one head and the child as another, if you had two children living with you, you could, gift a third, so give away 2/3. So yeah, as a rule of thumb, it's very safe to gift 50% of the property to one child and the parents to retain 50%. So the shared occupancy gift itself is a pet. So you do have the 7-year rule. The gift itself might bring you under the 2 million immediately, where there is no 7-year readback, of course. So again, there could be an immediate saving, but the bigger savings will come in after 3 years and 7 years as taper relief and the 7-year rule kick in. You don't actually have to put the child on the legal title of the property. That can stay in the parents' names. As long as we give away, a slice of the underlying beneficial interest, we can do it by declaration of trust. That's the tax event, so the legal title can stay in the parent's name and they're holding it on trust. There's no CGT because of main residence relief. If the property is the child's main residence going forward, we've got no CGT going forward either. So a very good option all round if there is an opportunity. You do need to consider what happens if occupancy ceases. So as soon as the child moves out, you have got a reservation of benefit issue and you'd have to pay market rent immediately. Otherwise, the whole arrangement fails and you've got another 7-year period. What happens if the donor dies within 7 years? You might need to think about the tax liability because, of course, the inheritance tax attaches to the gift itself, so the recipient is liable. So you could insure against that or provide for it in another way. The survivor could make a gift or it could be provided for in the will. What happens if the donee dies? What if the child dies? The parents could end up owning their property with a complete stranger if the child's left their share, their estate, to a third party. It's a bit silly for the child to leave it back to the parents. That undoes all the inheritance tax planning. But you might want to provide that the child's left it to their siblings, for example. And what if the property itself is sold? Well, don't be under any illusion, there has been a gift here. So if the property is sold, the proceeds will be split 50-50 between parents and child. And consider possibly the need for a flexible will. If the child has got siblings, you've made a massive lifetime gift here, you're going to need to balance up. So a discretionary will probably is in order. And also the discretionary will could cope with any imbalance due to inheritance tax. If the nil rate band is lost because of the death within 7 years, it could balance up the whole arrangement as far as possible. So moving away from shared occupancy gifts to the other main option, which is a gift with lease back. So this isn't rocket science. You literally give away your property and then you lease it back off your children. It's suitable for clients who are in reasonably good health, have got an appetite for inheritance tax planning. They can get their head around actually giving away their property. Some people just don't like that idea. And they've got sufficient funds and income to pay the market rent, which is going to be, a reasonable amount of money, and it's not insignificant. So the gift itself is a pet. We are outside the GROB and POAT regime because of the full market rent. So the market rent is key here. We can give security of tenure through an appropriate lease. I like a lease for life. I'll talk about that a little bit more later. You don't have to give away the whole house. You can give away part of the house. So if you feel that, a gift of the whole house is too much, just gift, a share of the underlying beneficial interest, so 25%, 50%, whatever the parents would like to do. The only downside of a partial gift is that you can't grant a lease, because a lease has to be, exclusive possession. So you have to have a lease of the whole property. So where there's a partial gift, you can't do a lease, but you can do a co-ownership agreement instead. And if you want, another layer of asset protection, you could make a gift of a share of the property to a discretionary trust. They're limited to 650, for a married couple, but you could then protect against, the divorce of your children or bankruptcy of your children. You're in total control. So that's appealing to some clients. So what is market rent? Well, put simply, it's what the market will bear. And really the only way to establish this is to instruct a surveyor to give you a red book valuation. Now the revenue, like the rent to be negotiated at arm's length, which in theory would mean the parents and the child instruct surveyors and then they negotiate the rent. In my experience, the clients, just do not want to do that. The parents are paying for all of this. They don't want to pay 2 lots of professional fees. So I have found a sort of practical way forward here where we just get one valuation, but we write into the lease or the co-ownership agreement that it's a contractual obligation that market rent has to be paid and that it will be determined by expert opinion. So this means that on death, if the revenue start questioning whether market rent has been paid, you can determine what that market rent would be. So you can get another valuation at that point, and any shortfall becomes a debt of the estate. So it just makes sure that you don't fall at a very important hurdle, because don't forget, if a GROB arises for even one day, the whole gift is back in the estate for another 7-year period. So it's absolutely vital that market rent is paid. Now, some clients don't like paying market rent. They just don't like handing over the money. They think it's tax inefficient because it's going to be taxed in the hands of their children. But I think it's fairly tax neutral, and I try and get them to see this, in the bigger picture, because really the children are just getting an advance on their inheritance. And yes, they are paying income tax on it, probably at 40%. But if they retained that market rent in their estate, it would suffer 40% inheritance tax. So really, they're no worse off. So moving on to the lease, it doesn't really matter what type of lease. You don't even have to have a formal lease. An AST doesn't give you any security of tenure. A fixed term, say 10 to 20 years, if your clients are in their 70s, would probably be fine, but there'll be quite a lot of stamp duty to pay on that because it's done on the value of the lease. So I like a lease for life because it's treated as having an initial 1-year term. So it's very sort of cost effective from a stamp duty point of view. If your clients live 10 years, you only pay 10 years worth of stamp duty and so on. Just be a little bit careful there. For lots of purposes, a lease for life is treated as a 90-year term, but you don't want 90 years in your lease because that would trigger stamp duty on a 90-year period. So just a little bit of caution there. And where you're gifting part of the property, you can't get the security of tenure because you can't grant a lease. But you can have an agreement that sets out how the costs are going to be paid on the property, who pays the bills, who pays the insurance, and you can tie in that market rent point that I was talking about. Okay, so what about capital gains tax? Well, obviously it's important that you have got private residence release on the property, so you need to be careful about, you know, big gardens that fall foul of that, and you might need to have a plan drawn up that just covers, you know, the main residence without surrounding land. Again, going forward, won't qualify for private residence relief in the hands of the children because they're not living there, and there won't be enough uplift on your client's death. However, you know, CGT is 28% of the gain going forward, the future gain, whereas IHT is 40% of the whole value of the property. And even more importantly, when you make a gift, you freeze the value of the property at the date of the gift for inheritance tax. So in my mind, although CGT is a slight negative with this option, you know, the saving of IHT massively outweighs, you know, the CGT that you're going to suffer. You just need to crunch the numbers. It might be helpful to have multiple children, you know, a big family, so you've got lots of children to gift to, so you've got multiple annual exemptions. Or it works quite well where the family home is never going to be sold, so that paper gain is never going to be realised. Just, you know, remember, if gift tax is introduced, you know, this type of planning just won't be possible because that lifetime gift would suffer, you know, tax at that point under the new regime. So this is the type of planning I'm sort of saying where you really ought to be doing while we still can. So just a couple of other options on the family home that I know you're aware of. So downsizing, you know, great for releasing cash, but the cost of moving is very, very high. You know, lots of clients don't want to do it. But if you do it, you can obviously invest in business relievable or gift it or spend it. If you don't want to move, if your clients don't want to move, you could take out equity release. I think this is much underused. You know, equity release is, you know, very good deals at the moment, and that cash can be gifted or spent, you know, to reduce the IHT bill. You can't invest in business relievable because the debt is set against the relievable asset since 2014, so that doesn't work. But certainly gifting equity release proceeds is an option. So moving away from the family home to the dreaded property portfolios. Now, property portfolios are very problematic because they tend to hold huge paper gains. So gifting them outright is prohibitive because they trigger CGT. Transferring them into trust is a no-go because of the 20% entry, and they're usually worth, you know, way too much to get below the nil rate band. So you can, you know, sell individual properties, pay the CGT and gift the proceeds, you know, simple but effective. You know, there is an argument to say if CGT is going to go up, you know, perhaps we should be doing that, especially where we've got a stamp duty holiday. But usually the only viable option is to try and stop the rot. And this takes a little bit of hard work, I'm afraid. You need to have, you know, enough of a portfolio to be able to incorporate so that you can gift away the future gain. So I'll explain that in a little bit more detail. So we've got our property portfolio and we're looking at turning it into a property company. CGT is a big issue, so we want incorporation relief. Well, that's fine if you've got an existing business and you can demonstrate to HMRC that it is an existing business. So you need a big enough property portfolio that's going to actually warrant, you know, 20 hours or so plus a week effort, you know, by your clients, husband and wife business, for the revenue to see it as a going concern. And then this incorporation relief is given automatically. So all the gain on the properties is rolled over into the company. So that's the first hurdle. The next problem is stamp duty. Obviously, when you transfer property into a company, it triggers stamp duty at market value. unless you qualify for stamp duty relief on incorporation. Now, this has to be claimed. You need to have an existing partnership, again, husband and wife partnership. That needs to be sort of formally in existence, so registered with the revenue, ideally a partnership agreement, partnership accounts. And when you incorporate, so when you form your company, the ownership needs to match the partnership. So if it's a husband and wife partnership, it has to be a husband and wife shareholding. So we've now got our property portfolio into our company and we haven't paid any tax. So all good so far. Once you've got your company, what we then do is we create a new class of shares, B shares. So these shares have the future economic rights of the company, i.e. they have the capital gain going forward and the future dividend rights. And these are the children's shares. The parent shares have limited dividend rights, say for the next 10 to 20 years, and the capital value is frozen. So this means that as every day goes by, the A shares become less valuable and the B shares become more valuable. The other thing is that the date that the B shares are given to the children, they have a nominal value. So the value of the gift, the pet, is very low. So the 7-year rule doesn't really even feature. So as soon as those shares have been gifted, the gain going forward is outside the estate. The A shares, the shares in the parent's estate with the frozen value, will get CGT uplift on death. And the B shares, the future value is in the children's estate. So you can see how it's stopping the rot. The IHT problem is, mitigated for the future. So moving away from an existing property portfolio and onto family investment companies. So really, it's a very similar concept and very similar, in fact, to a loan trust arrangement. It's ideal for clients who have come into some cash. So they may have exited a business and they've got more money than they know what to do with. So they want to set some aside for the children, but the children aren't old enough or aren't ready, to inherit those sums outright. So it's all about control again. And the best way for the company to be set up is with a loan. So the parents loan in, say, £1 million. The parents hold the A shares again, the controlling shares. They can have dividend rights if they want them, but if you're doing IHT mitigation, I question why they need dividend rights. The B shares, usually non-voting, but with the economic rights. So again, capital growth and dividend rights. So again, on day one, the value of the company is in the loan, which is in the parent's estate. So the B shares have nominal value when they are gifted. So the loan repayments that the parents may wish to take, are effectively tax-free. It's a capital payment back. So it can provide for the sort of their income for later life on a sort of tax-free basis, if you like. The capital growth is sheltered from inheritance tax in the children's estate. And if the investments are doing well and these, generating these profits, they're sheltered from income tax until the parents actually decide to pay out dividends. So again, you've got that, you've got that control, you've got this money rolling up in the family investment company, that can pay out to the children as and when they need the money or as and when they're ready to receive it. So as I said, the loan is still in the parent's estate. B shares gifted at nominal value. The 7-year rule doesn't really feature because of the IHT being frozen at the date of the gift, the IHT value. There's no restriction on the amount of the loan. You can loan as much as you want. You're outside the relevant property regime, so we don't have the issue of entry, exit, and 10-yearly charges that we do have with trusts. And those charges, can mount up, decade after decade, whereas a family investment company can roll, can run and run. If you want an extra layer of protection, the B shares, when they have their nominal value, can be gifted to a family trust. So this could be on top of the 650, because the shares won't have any value. So it does make sense to put the B shares into a family trust on day one and then review the situation at year 9, because those shares could be distributed at year 9 with no exit. So that's worth looking at, just for an added layer of protection against the children's position. Okay, so just to summarize, it's really important that we start to look for these opportunities to save big numbers of inheritance tax while we still can. I like the main residence because it's so valuable, but also we have a lot of clients who are running property portfolios, and because of the prep that's needed to mitigate tax there, it probably is a good idea to look and start lining things up to get those reliefs, so that we can get them into a company and gift those B shares away. And family investment companies, yes, the revenue have made it quite well known that they don't particularly like them, but they haven't done anything about it so far. So it's still a very good opportunity where you've got clients with cash sums that they can happily loan in. And then more traditional planning, the nil rate band and residence nil rate band. There's lots we can do around tax planning wills and tax mitigation there. These are very appropriate for couples with assets over $1 million. So as soon as they've got an IHT liability, this type of planning can be very attractive. Business relief and agricultural relief, I really think there's merit in looking at double wrapping these assets. Yes, we've got the relief at the moment, but that might disappear. So why don't you put your relievable assets into trust as well, just to be sure? Lifetime trusts we've spoken about, look for what assets can be put in, assets at a nominal value that are going to go up. Surplus income that's immediately exempt, so they can top up into trust. So just trying to get assets out of the estate as and when, and you can just build a fund over time that can be passed on to the next generation. And deeds of variation, of course, there are those perfect situations where there's no downside to redirecting assets to a trust, so look out for those. And that brings us to the end of the material. So Stuart, I don't know whether we've had any questions in during that time.
Yeah, we've had a couple of questions and a comment. I'll start with a comment actually, because I think it's a useful one. It's from Brian Owen. He sent a comment. He says, when talking about gift with lease back, children could put rent received to pensions if available and negate income tax.
Yeah, so again, I talked about it being tax neutral. I think that's going a step further and making it so that there's actually an advantage to it, because you're saving inheritance tax, because obviously they're paying rent, so there's no 7-year tail that's immediately outside the parents' estate. And if the children then pop it into a pension, it's definitely sort of win-win situation. So yes, I agree, Brian. Good idea.
And then we've got a few questions, which I'll take you through, Camilla. First from anonymous attendee, and they've asked if a shared occupancy or gift with lease back, can equity release be undertaken if needs be? This anonymous attendee assumes not.
Well, this is sort of a question that comes up a lot. Lenders like the beneficial interest to match the legal title. And some of this planning that I talked about, it won't necessarily do that. So if you hide a different ownership from the lender, you will be in breach of your term. So you could apply for equity release, the parents could, and if they don't disclose the underlying beneficial ownership, they are breaching the terms of the mortgage. So really, it would be best to add the children to the title, come clean with the lender, and apply for the equity release on that basis, which is definitely possible. Yeah.
Okay. The next question, Barry Browning asks, what planning can you do if the buy-to-let properties have mortgages?
Again, it's almost the same point. So whatever you do with the underlying beneficial interest, the lender really wants to know about, because they want everything to be in the line. However, it's very unlikely that they are going to get wind of a gift of beneficial interest, because the land registry title stays the same. So it really comes down to the client and whether they are prepared to breach the terms of their mortgage or not. I mean, if they've got the ability to repay the mortgage, you know, at the drop of the hat, I wouldn't be too concerned about it. But if forfeiture would cause them, you know, hardship, I think you need to be more careful. But yeah, certainly the same things apply. So you could gift a share of the property, you know, to the children. It would trigger capital gains tax. You could put the property into trust and hold over the gain. But yeah, you've got this point of ownership that needs to be looked at. It just makes it more complicated when there's a mortgage.
Okay, thank you. Another question, anonymous attendee has asked whether how often market rent needs to be reviewed when talking about gift with lease back.
Okay, so I mean, I think I talked about this a lot, about, you know, the need to make sure market rent is paid throughout. So in theory, regular reviews, I mean, I would say every, you know, 1 to 2 years, or, you know, it depends how, you know, volatile the market is. At the moment, you know, things are changing by the day, so, you know, it's tricky. But the option of making it a contractual obligation that market rent is paid does lessen the need for regular rent reviews, which is why I really like that solution. So I would say, you know, every sort of 2 to 5 years ideally. But if you've got clients that just don't want to do it, you can sort of sweep it all up, you know, when they both die. It might mean there's quite a big back payment to make from the estate.
Okay, and just do one more, if you're okay too, Camilla. Andrew Chaplin asks, if a flat is put into trust, can all rent go in with no tax liability?
No, that's the short answer. No, so if you put a flat into trust, the income from the flat will follow the asset in trust, and then that rent is taxed in the hands of the trustees. So obviously the trustees' rate varies, but on rental income it's 45%. So the trustees would have to do a return on that rent and pay 45% income tax. That could be mitigated if the income is distributed to, say, basic rate paying beneficiaries, and then that 45% rate can be claimed back. So the 25% difference can be claimed back by the beneficiary. Or if you're happy to mandate the income, the trustees can sign a trustees resolution to say that all income will be paid to this beneficiary. Then the trustees don't even have to do a tax return, and the income is always taxed in the hands of the beneficiary. So basically the income follows the asset, but the trustees can pay it out to try and mitigate the trustees' rate of income tax.
Okay. I've had a couple more questions come in. I don't know what you think, Camilla, about, want to keep this to time. Shall we follow up on those questions directly with the people who've asked them?
And we've got a few minutes, but should we let's take a couple more, yeah, and then we'll stop at an hour. Yeah.
Okay, great. So Andrew Chaplin asked another question: are pension fund transfers outside of the estate?
Yeah, well, yeah. So I mean, there's been recent case law on this, so it's not a simple answer. So if transfers are made within 2 years of death, you do need to be more careful, and it is worth reading up on the recent case law on this. But yeah, basically, pension transfers that are made longer ago than 2 years will be outside the estate. It's quite a complicated point on that 2-year window. It's all to do with, you know, whether a benefit's been conferred. So I'm happy to answer that separately. Yeah.
Okay, and the last one then is from an anonymous attendee, and they've asked, when thinking about a gift with lease back, what would you do if one of the couple were terminally ill?
Okay, it's interesting. I've got a matter with exactly that point at the moment, sadly. So the way is to do the gift from the healthy individual. So instead of doing a joint gift and sort of hedging your bets, you transfer the property interest across to the non-terminally ill individual, and then they make the gift to the children. Of course, it's not totally foolproof. You know, your healthy client could get run over, and be the first to die. So, always difficult situation. I mean, when you've got, incidentally, when you've got a terminally ill client, there are other options for CGT planning, transferring assets with a paper gain to the individual who's going to pass away soon, so that they get the uplift on death. That is accepted, planning. So bear that in mind. Good. Is that everything for now? Yeah, we'll leave it there, shall we? Yeah.
Yeah.
Well, thank you everybody for joining us. I hope that was useful. You're always welcome to email me with specific questions if you've got them. I am hoping to do a further webinar before Christmas, and I was thinking of having a sort of ask the expert. I'm not sure I am an expert, but ask me whatever questions you like, which may be of interest. Maybe we'll keep it a bit shorter and see how that goes. So hopefully we'll send out a date for that soon. Thank you all very much, and just a reminder that this has been recorded and it will be on the website if you've got any colleagues who would like to see it. Yeah, thank you very much, and thank you, Stuart.
Thanks a lot for watching, guys. Thanks a lot.